First item is attendance. I note that Chairman Petoskey is not here, and we have one vacancy. So at this point, we will need to appoint a chair, temporary chair for the meeting. Are there any motions?
Is there anyone that wants? Oh, would you like it? Make a motion for our chair.
Okay, one motion to appoint David Olson as chair.
Support.
Support by Trustee Barnett. All those in favor?
Aye.
Aye. Okay. Chairman Olson.
Okay. Thank you, Art. For attendance, then we have,
The microphone.
Public comment.
After attendance, we have public comment. Is there any public comment
Doing great. Successful already.
seeing as we have no public comment, we'll go to the approval of minutes from the last meeting. Is there a motion to approve those minutes?
So moved.
Second.
All those in favor?
Aye.
Aye.
Opposed, any? Thank you. The minutes are approved, which allows us to go to the discussion items. The financial investment review. Brian, I'll turn over to you.
All right. I can make it full screen. So as we were talking through things on the retiree healthcare side, I'd mentioned that I was trying to come up with kind of a theme or just a comment around how to describe the third quarter. And my colleague, Mike, had made the comment that the third quarter of 23 felt a lot like 22, just from the standpoint of, there was really nowhere to hide from a performance standpoint. And I say nowhere to hide because when you look across the board from an equity market standpoint, everything's down between 3 to 5%, and you look at fixed income and it was down 3%. So whatever your mix was, you were 60% of a 3 to 5% decline and you were 40% of a 3% decline. So it was kind of reminiscent of 22, although not the negative 17% return we saw out of the S&P 500 and the negative 17% return we saw out of the Bloomberg aggregate bond index. So, stocks kind of ground sideways, slightly negative for the quarter, and fixed income, the story was really not so much changes on the front end of the curve as the Fed was a little bit slower from a reaction standpoint, but just longer term securities moving up significantly. Couple comments from different things that I was reading earlier this morning. 30-year fixed, according to Freddie Mac, is now averaging 7.3%. Hasn't been that high since 2000. Looking at things from a housing affordability standpoint and comparing buying a home today on a 30-year fixed versus renting, and we are at housing affordability levels that we haven't seen since 1982. And I think about it, I think about buying my first house and complaining about paying, 6.5%, and my dad looking at me going, "Are you nuts?" When we bought the house that you grew up in 1982, we paid 17%. So kind of reminisce and thinking back to just the impact of, we're talking about 40-year, I don't know if we call this 40-year lows in affordability or 40-year highs in affordability, but it's certainly kind of a wait and see and could have quite the chilling effect on things from a housing market standpoint. So where are we from a defined benefit standpoint? I always think this chart is, for me, the most powerful. And candidly, it's really what's in the bottom corner here. Because the squiggly lines are interesting, but the table at the bottom, to me, is really the proof. The decision years ago to invest in the equity markets, to add risk to the portfolio and not just depend upon the contract. If we go back to April of 14, so coming up on 9.5 years here, the value of the portfolio is just over $84 million. We've had net negative cash flow out, so that's really cash transferring out of this portfolio and into the Prudential contract to pay benefits. We've paid out $48.8, almost $48.9 million in cash flow, or transferred that over to the contract. So even with a little bit of a decline we've seen here, if we look at that 9.5-year track record, the equity markets have added $46.2 million in value to this portfolio for us to be at 81.5, call it $81.6 million today. And you want to make that comparison, had we not, and think about it, while fixed income markets are certainly attractive today, for a large portion of that last 10 years, money markets were paying 0. Fixed income was paying 1 to 2%. But absent any growth in the portfolio, we wouldn't be sitting at $81.5 million today. If we adjust that $84 million for cash flow, the value of the portfolio today would have been just over $35 million. So the decision to take on risk in an intelligent and prudent manner, regardless of what's happened in the last couple months from an equity market standpoint, regardless of what happened in 22 from an equity market standpoint, has certainly been a meaningful and significant contribution to the health of the system. So how did the DB equity portfolio fare? As I'd mentioned, there was really no place to hide during the quarter. There's no fixed income here, but fixed income wouldn't have benefited anyone in the first place in the quarter. The one, I think, positive contributor, at least a little bit, would be from a real estate standpoint. But the overall portfolio for the quarter down 4.5%, lagged the policy index that was down 3.3%, and lagged the median global equity manager that was down 4% for that same time period. Longer term numbers continue to be very, very strong, well into positive territory. So what helped and what hurt? So I was looking through and preparing comments and digging through attribution on each of these portfolios. There wasn't necessarily any strategy that significantly outperformed. There wasn't necessarily any strategy that significantly underperformed. It was all just kind of middling performance. It was like outperformed by 1% or 2%, underperformed by 1% or 2%. And the other common theme has been kind of what helped hurt and what hurt helped. And it's this cycle. You're going to hear some common names. So looking at Ancora, outperformed for the quarter by about 1.3%. So nice outperformance for them. Still no victory laps for negative numbers, but their outperformance was driven by stock selection and healthcare, notably names like United Healthcare and AbbVie. S&P 500, no surprises out of Fidelity Index Fund. What is interesting is the single biggest detractor from performance in the S&P 500 was Apple. Not because it was significantly into negative territory, but because it was 7.5% of the benchmark and it was down 10% in the quarter. Edgewood underperformed for the quarter. I would say from previous conversations, if we'd said Edgewood underperformed, it was because of the lack of exposure to Apple. Ironically, not owning Apple was a source of outperformance for them because Apple's 13% of their benchmark. But their underperformance was really because of an overweight to names like Netflix, ASML, and Estee Lauder. Clarkston underperformed. This one was a bit of a surprise. Clarkston's traditionally held up really well, but a couple of names for them, notably Hillenbrand, U.S. Foods, and Cisco. And those last two, U.S. Foods and Cisco, have been a source of outperformance for them. Kind of the COVID reopening trade, as we're all, right, everybody's been going back out to eat. From a traveling standpoint, getting a restaurant reservation's become an exercise in futility at times. But slight underperformance for them. Fidelity Extended Market, no surprises there. Interestingly enough, some of the biggest names have been ones we've talked about in the past: Marvel, Snowflake, and Block. Looking at things from an international equity standpoint, Oakmark underperformed due to autos. Ironically, it's been one of their biggest drivers of outperformance a couple quarters leading up to this, but three names, Continental AG, BMW, and Mercedes, all traded off in the quarter. JP Morgan, emerging market portfolio, underperformed for the quarter because of some of their biggest names, also some of the biggest names in the index, notably Tencent, Taiwan Semiconductor, and Samsung. And then finally, from a real estate standpoint, nothing new out of TerraCap. That pricing will probably come in mid-November. It's usually 45 days after the close of the quarter. Expect that to be flat. And then principal. So we continue to see that impact of rising interest rate environment. It is has an offsetting effect on commercial real estate prices. So that's where we see, broad, high quality commercial real estate in the U.S. down 12% in the last year. Principal's held in quite well. For them, significant overweight to things like industrials and multifamily, significant underweight to office and traditional retail. So I think they're positioned well. The other piece that's, I think, of note, we have not asked for any money back from principal, but with other clients that are invested in that fund, right? So that fund offers quarterly liquidity, and they offer liquidity to the extent that they can provide it, but in periods of stress, they have the ability to close the redemption window. So they did that in 21, 22, just like, hey, with what's going on in the fixed income markets, the unknown impact of things from a real estate standpoint, it's really not prudent for us to be offering liquidity because it's going to harm existing investors. They've reopened and are now offering redemption, so it's kind of a sign of things unthawing. We also had an update meeting last week with TerraCap, so recall that Fund 5 is a closed-end fund, so fully deployed, Nothing new being purchased, so it's working through the business plan for each of the underlying properties, which is predominantly multifamily and office. But when I say office, it's in areas like Austin, Orlando, right? High growth areas where we have a net absorption and a high demand for office space. Conversation with them, with Steve Hagenbuckle, and it was really around, hey, bought a lot of these properties in 2021 and early 22, floating rate debt on them, refinancing, where are you at? And they're in a really good position from the standpoint of the NOI, the net operating income that they've been able to drive. Essentially, any increase that they have in debt service because of a rise in interest rates on the underlying mortgages they have on their property are more than offset by the increased rents. So even in this kind of, hey, if rates stay higher for longer scenario, they're like, look, we're going to be just fine. It just may add another year on to our investment cycle just to kind of work through things. The other piece that they had commented is I think about like Wall Street's big on coming up with some phrases, right? It's, the FANG stocks, the Fat Man stocks, now it's the Magnificent Seven. But from a real estate standpoint, the comment is survive until 25. And that's get through this rate cycle with the view that, near the end of 24 and into 25, we start to see rates decline, and that should be a tailwind from a real estate standpoint. He had made that comment in the meeting, and that's where he posed, like, well, what happens if it's not, like, what if this is the new normal? Like, a 5% on a 10-year treasury or a 5% on a 30-year fixed is actually slightly below the long-term average for U.S. treasuries. So we feel like this is crazy high interest rates because it is for the last 15 to 20 years, but from a longer-term standpoint, this is still below average. And that's where he had come back and said, look, we're going to be fine. We're excited. They're in the market with their new fund right now, which we're evaluating. We're excited to be a buyer in the coming years of real estate. But with what we have, because of where it's located and the quality of the properties, if this is the new normal from an interest rate standpoint, we're going to be just fine and are going to be attractive. And to give you an idea, we were looking at some of the apartment buildings in the portfolio, and it's a 2-bedroom apartment in the greater Austin area renting for $1,500 a month. So this isn't $3,000 a month or $4,000 a month kind of super high-end luxury apartments. These are, I don't want to call it affordable rate, but like it's $1,500 a month, that's $1,600 a month, and that's an infinitely more affordable and kind of recession-proof part of the market to be in versus some of the crazy high-end stuff. So all in all, from a real estate standpoint, good positioning. Going back to the equity portfolio, we're going to do some follow-up information and analysis on Edgewood and Clarkson, just looking at some rolling kind of longer-term performance for them. Again, we remain confident and convicted in both teams, but just want to show you some of that data that we think will get you to that same place. All in all, trying to end on a positive note. It's just a middling quarter. There was really nowhere to hide. No significant themes from an equity market standpoint. I'll pause there and see if there's any questions.
I don't have a question per se. I just want to look at page 6 and reflect that our allocations across asset classes are well within policy and very close to the targets. So given that, is there any recommendation that we need to rebalance at this point?
No, not at this time.
Okay.
How long do things sit on your wait list before, because I know we have some that are watch lists, some have been on there for a while, some came on, some came off. How long do things sit on your watch list before you make moves typically?
So if it's qualitative, so there's been personnel change or an organizational change that's going to drive being placed on the watch list, that's a pretty quick determination.
Yeah.
If it's quantitative, so if it's performance driven, I would say Edgewood and Clarkson are on the watch list because of underperformance. That's where we go back and we'll have a little bit more patience, because if there's been no change from a qualitative standpoint, so if the people are the same, if the process is the same, those are the two things that have driven historical performance that made it attractive to add the strategy to the portfolio, right? Because if the people in the process drove underperformance, like, well, why? I'm not gonna give you money to invest, right? We're not gonna hire you. So we look back, and this is part of the analysis that we'll pull together and distribute, is we go back and look at, like Clarkson as an example.
That's what I'm
They've
thinking of.
underperformed in the past, and have outperformed, right? And so they have historically, when they've gone through periods of significant underperformance, have rewarded patience by not only recovering that underperformance, so getting back to zero versus the benchmark, and then generating excess performance above that. So it's showing you some of those historical cycles and saying, like, hey, from year 1 to year 3, this period was underperformance. By year 4, they had recovered it, and by year 5, this was the margin, the excess that they've delivered. It's showing. I want to show you past cycles where we've had performance like what we have in the last year. If you go back, like in 22, when small cap was down 20+%, they were flat. So, but in 21, when markets were roaring, they had underperformed, right? So it's as long as they've stayed consistent from a process standpoint, and there's been no change from a people standpoint, we'll be a little bit more patient during periods of underperformance, because we've seen it happen before and have consistently been rewarded. And it's the same story with Edgewood. And in either of those scenarios, particularly with Edgewood, those 11 partners have reinvested a significant amount of their own personal net worth back into the portfolio. Not into the firm, but into the 22 stocks that are the large cap growth portfolio. So that gives us a bit more confidence of, like, hey, like, we realize this is your this is your livelihood, this is your job on a day-to-day basis, but when you go and pull out your personal checkbook and say, we've seen this before where we've underperformed benchmark and underperformed peers, this has been a great buying opportunity, I'm adding personal funds into the portfolio that we manage on behalf of all of our clients, because of my conviction in the names.
Clarkson was one I was thinking of.
Mm-hmm.
Yeah, and I think that's appropriate right now, but I think it still is appropriate that they're on the watch list.
Absolutely.
It's
Yep.
still a little bit,
And I didn't think you'd drop them this year. I just want to know what the normal cycle is for something like that.
It's usually 6 to 9 months from a watch
Stay on
list
the watch
standpoint.
list? Well, they've been on.
They would have come off last year because of the significant outperformance, but with what's gone on, particularly in the third quarter, it would place them back on the watch list
Okay.
because their third quarter performance has now dragged down their 1 year and their 3 year number, where it would trigger
Okay.
closer scrutiny.
Right, Danny, his point is that if you look on page 4, under their long-term returns,
Oh, I saw those.
okay, so on a 1-year basis, they're underperforming by 2%, but on a 3-year basis, they're overperforming by 2%.
They did so poorly in 21 that they were a huge topic.
I don't
And
remember.
they, like you said, they got flat, yay, on the
Well, they
next
outperformed
year.
by like 20% the
Right.
next year. Yeah.
Right, but then it
Yeah.
seems like they're like a cycle. So my question is it good to stay with the roller coaster versus what's the payoff if you pick somebody who just consistently performs? I know some of them can't. I'm talking about they don't perform well when things are good. So that's why, as a layman asking these questions, it also helps me understand why we make the decisions we do from the professionals of, from a layman's perspective, it seems like 5 years is a long, you're saying like you'll get 4 years of bad and then you'll get a payout at 5. Is there a better group that maybe you get payouts more often?
So I would say in a 5-year cycle, you get 2 years of bad and 3 years of good. But it takes, a year and a half of the 3 good years to recoup the 2 years of bad. So, right, 21 was an year of underperformance. 22 was significant outperformance. So, underwater, back above water.
Now heading back
Now
under.
back.
So with
Couple
them-
things. Number one, they're not your only small cap manager. We have them paired with an index fund,
Right.
right? So this idea of, look, you do great on a long-term basis, and like their 5-year return, that's your live return, is 7.8%. Benchmarks 4.5. So they've outperformed by, 2.3% they've made you 10% more money in the last 5 years than their index did,
Right.
right? So even with underperformance in the last year, they're still cumulative 10% ahead in the last 5 years. I'd say that's a solid track record.
There's not a competitor that's even higher than that.
Marginally.
Okay.
But I would tell you that anyone that's able to generate that type of outperformance is going to give you a year like you've had in the last year at Clarkston. Like it's never consistent outperformance, and
Right.
not to a large degree.
Right.
So we always pair Clarkston either with another active manager that has that doesn't look like them, right? That outperforms at different times and underperforms at different times, so that you've got some benefit of diversification. Or we pair them with an index fund and say, look, Clarkston's going to look nothing like the benchmark, and that's fine, and we're going to have patience with them. But because they're more expensive, we're going to pair it with an index fund, so that traditionally, from an index fund standpoint, if you think about Clarkston and the index, like when times are really, really good, Clarkston's going to lag a little bit because they're more conservative. Index fund's going to capture 100% of it. But when times are bad, index fund's going to capture 100% of the negative performance. Clarkston's going to do a good job protecting. And the combination of those two over time is going to give you the net best benefit for the equity portfolio.
And if you're telling me that Clarkston is the best of their kind, and there's no one better that's performing even better that's similar to them, then I'm okay. My question is if they're not the only one like them, so not the index, the others, and no one else is performing better than them on a 5-year, then we're good. I was trying to see, I guess I didn't realize that somebody in their group doesn't normally perform better over 5 years than what they're doing. That was my question, was are they the best of the best?
So go to page 11.
For like their main competitors that we would normally switch to.
You know, they're top 20% to top third of their pack when you look on a longer term basis. So there are others that have done better. There is also a bit of survivorship bias. You know, if you go out of business, if you went out of business a couple years ago because of underperformance, you're no longer in the universe. So the longer your track record is,
Yeah.
the tougher that long-term number gets, because the only ones that have a 10-year track record are the ones that have survived for the last 10 years. Well, there's a lot of them that dropped off over the course of that time period because they underperformed, assets left, and the strategy shuttered. But like on a 10-year basis, for example, they rank in the 17th percentile, so that means they've outperformed 83% of their peers. The flip side of that, and Danny, to your question is, okay, if there were 100 strategies in this universe, 16 of them did better.
Right.
There's probably 1 or 2 of them that are like crazy lights out, but those could be strategies that are like, we own 10 stocks, where you look at it and you'd be like,
Right.
listen, this is great, but like from a risk standpoint, this is just not for me.
Yeah.
Because in a 10-year cycle, they'd have 2 great years where they outperform by 50% and 8 terrible years. And like from a behavioral standpoint, what's the likelihood of you as an investor saying like, I'm going to give you 10 years when I'm 5 years in and you're significantly behind the benchmark? So some of those are almost kind of uninvestable strategies because your brain kicks in,
Right.
where you're like, I can't as a fiduciary justify continuing to hold this strategy, and inevitably 6 months after you fire them, that's when the rocket gets lit and they take off and outperform.
Thank you.
I actually think that the alternative is almost going to the index fund, just increasing the thing if it doesn't work out, because that way, you're saying that over time, can somebody really consistently do that? They have had a good track record, previously for that, but.
And that's where, and Dave, that's a great point. We can still look at this page, like large cap core. So top right-hand corner under the 10-year, you see, as you work your way across, it's the S&P 500, but you see top right, you see 11.91 and then 12 in parentheses. So the S&P 500 in a large cap core universe ranks in the 12th percentile. So 88% of active strategies in the last 10 years have underperformed the S&P 500. That's why we own the S&P 500. I think about the odds. If I go down, so we talked about Clarkston, 10.61 in that 17. Underneath it, you see the Russell 2500 index. So their benchmark has done 7.9% in the last 10 years. And in their peer group, that benchmark ranks in the 73rd percentile. So 73% of managers in the last 10 years, 73% of small mid-cap U.S. equity managers have outperformed the benchmark. Okay, if I've got to pick, I'd rather pick from a pool of 73% that have outperformed versus from a pool of 12% that have outperformed, right? What are the odds of getting the decision right? So that's where you see more active management on the small cap side and less active management on the large cap side, because the margin of success is either this big or this big, and I'd much rather pick from a pool of managers this big. Great questions.
Okay, anything else? Is there any new business that,
Next meeting.
oh, our next meeting is in January 24th, at 8 o'clock the same time. Any new business?
Yeah, in terms of new business, we have a vacancy for a township resident on this committee. We have released a notice requesting submissions. I believe the deadline is November 16th, maybe. And so, oops, sorry, I can't find it right now. Please contact my office if you have a question or interested in applying for this committee. If anyone on the committee knows anybody, please ask them to apply.
Great, thank you. All right, we're to the point, I guess, is there a motion to adjourn?
So moved.
Or
All in favor?
Aye.
It's unanimous.